Hello and welcome to this very special show. I'm in conversation today with one of India's best known value investors, Raamdeo Agrawal. Thanks very much for joining me on the show. The concept of growth versus moat for a company, when you're looking at a company that's moving from the mid to mega category, how do you differentiate between these two, and which one would you say is more important?
Now, in last 20-25 years, there are hundreds and thousands of books have come on moat. So moat investing has become very common. People have understood what is a good business and bad business. Basically, companies with huge moat is in India like Colgate, INVST, these companies have moat, but growth is not guaranteed. So what happens is, once you have priced the moat fully, then the only way you can make money is if you have the growth. And in growth also, it should not have been priced.
Right.
Okay, so mispriced growth with the moat is what is the target of any investor.
Right, it's the ideal combination.
That's the ideal combination, where then what happens is, with the moat you are guaranteed of not sinking, that your stocks will not sink. But with the growth, if it grows at 30%, most likely you are going to make money at least 30%, or if there is re-rating, there may be 35%. So that's why if you see in a lot of high moated companies, the returns are not that great. Colgate for last 20 years is underperformed the market. That's not known to many people. Okay, because the growth is only 10-11%, whereas the index earnings growth is more like 15-16%. Hence, index has given return of 16%, and Colgate has given return of just about 10%.
Right.
Plus dividend, of course. But index also has a dividend. So basically, what is important is, moat is not sufficient to make a lot of money in the future. Moat has to be combined with distinctly growing franchise.
Consumer retail has re-emerged as one of the largest wealth creating sectors. The largest wealth creating sector, yes. And you've also been very bullish on India's consumption story. But at this point in time, how should one really approach that sector? Because you've still got very high quality companies which are extremely expensive.
Yeah. So that's what is the trouble part of the this investing process, that you need to have moat and growth which market has not priced in.
Yes.
So clearly, because of this, not all the consumer companies will not make money, but obviously the return from this segment might remain a little subdued.
Right. Because
huge re-rating has happened. Companies which are available at 25-30 PE, they are trading at more like 50-55 PE multiples. So we have seen that over a period of time, these P multiples, they do get adjusted. So if P multiples remain heightened for very long periods, in that case maybe you can get the earnings, total earnings as your return. But if by chance they get derated for some reason, clearly your return will be less than your earnings growth.
Right.
So one has to be very careful. What it proves is that in this segment, any new company comes in, or any company gets onto a growth trajectory, it will be rewarded. Because in consumer, what happens is, you win. Consumer is a very very difficult segment, where consumer is very finicky, and once they get used to particular things, say if they are used to Colgate for toothpaste, or if it is used to say Fevicol for adhesives, it is very difficult to dislodge them from their habits.
Right.
So because entry barriers are very high, and yet we are consuming even the simple things very little in India. So opportunity to grow is very, very high. So what is looking to be a large company today can become significantly mega size companies. So I would not sell what I have, but I will be cautious in buying, building up the portfolio of consumer companies.
So the other sector, conversely, in fact, is metals and minings, which have, from the biggest value creators, they've now become the biggest value destroyers. Yes. Exactly. So stocks like NMDC, MOIL are all examples of very good businesses which are now extremely steeply discounted. But do you think that such kind of turnaround bets can be wealth creators going into the future? Would you say it's time to start looking at this sector really?
Personally, I would not, but at some point of time it will be, in the sense that they are so grossly oversold. But then the destruction of the commodity franchise is so total, in the sense that what has happened in 12 years has been demolished in 18 months. So what we are passing through is unprecedented. I have never seen this kind of readjustment. it happens once and then it comes back, like 2007 plunge and those kind of things. But what is happening is a complete destruction of the franchise, whether it is iron ore, whether it is aluminium, whether it is zinc, oil of course, gas, coal, nothing is spared. So this is very unprecedented time, and what happened in the first decade with the advent of China was also kind of extraordinary time. So I think for some time at least it will require stabilization. Right now it is still falling, but I think maybe in a 6 months or a year's time it will stabilize with a lot more pain, because this will lead to a lot of bankruptcies, you know, and then supply side will get squeezed, and then demand will steadily pick up, and somewhere equilibrium will come and things will stabilize. And so we have to wait for that period to happen. And if you know something very well, any company, and you know that they are the lowest cost producer, I think the only way in commodity it works is lowest cost producer and scale.
Right.
When these two things are there and management is good, and if you get it for throwaway price, definitely you must buy.
So the other concept that you talk about is reverse value migration. One sector which immediately comes to mind are the PSU banks. How should one really approach this space?
Basically, you're talking about value migration actually.
Yes.
So that has been one of the biggest value creators in India. In last 15 years, the size and the breadth of wealth created by this segment, I mean this concept, is unprecedented. What is value migration is that world will always be in a market economy, they will always be looking for a better business model, better value proposition to the customer from the same thing. One of the largest value migration is from Boston to Bangalore in IT. All the work which is happening in Bangalore could have been done in Boston, but they were expensive, 5 times, 3 times more expensive, and hence value has migrated to Indian companies, and that created Infosys and TCS, which are the top 2 companies in top 10.
Right.
Okay.
Right.
Now look at the pharma. Global pharma is migrating. Global generics are migrating to India, whether it is Sun Pharma or any other pharma company. They are making. Actually, they are not making money in India that much.
Correct.
Because they are profitable, but they are not growing that much. So they are making a lot of money abroad. That's another value migration. Same way, public sector banks, they were 100% till 95. Then private sector started coming in. HDFC Bank, ICICI Bank, all they opened the doors. And today they have become 1/3 of the entire thing, and almost 100% of the total profit.
Right.
So value has migrated from a public sector bank to private sector bank. So it's very challenging. I mean, PSU banks have, if they want to come back to the business, they have to change the business model. And since government owns it, government has to completely change the business model. And I don't have any prescription how exactly business model can be changed, but the survival will happen only if they change the business model.
Okay.
And it will require deep work. I mean, there are consultants who will suggest how do you make it competitive to the current set of professionally managed private sector banks.
Right.
But there is no way they can survive in current conditions.
Right. So until then, you think the private sector will continue to outperform?
They'll keep winning because they have taken 1/3 share. They'll take another 1/3 share. So they'll become Doordarshan. Finally, the entire media has gone to non-Doordarshan, and 20 years back it was all Doordarshan.
Correct.
So this is what exactly. I mean, PSU banks can become Doordarshan or BSNL. Again, value has migrated there.
Right.
So, but it's a very large sector. The whole economy runs on this. 2/3 of the economy runs. So the government is under tremendous pressure. How do they? And governments typically don't have this brilliance or intelligence to do all this.
Right.
So I don't know how. I mean, that's why it is prescribed that you sell. I mean, if you don't know how to repair it, you better sell it. So whosoever gets it, they'll be able to, repair it and make it competitive.
All right, time for a short break. We'll continue this conversation on the other side. Stay tuned. The report doesn't really mention any specific recommendations of which companies are on the cusp of crossing over from mid to mega. But how many such companies do you believe there are today?
Yeah, so what happens is we did the numbers from 95 till date. So as per the power law, like top 100 companies in any given year is 75% of the market cap and 85-87% of the profits. So it's a significant portion of the market. So about 10 to 12 companies every year they cross over from mid to mega. Okay, on a rolling basis, on a 5-year basis.
Right.
So we have to figure out, one has to figure out on a given in next 5 years, which are the 10 companies which are today below 100 will cross over to above 100.
Right.
Okay, for that only this Lollapalooza effect of growth in the sales, growth in the market, growth in the profitability, all those things must fall in place.
So among the fastest wealth creators, we've got names like Ajanta, Symphony, Aisha, Group Finance. But the question is, how do you know when to exit such stocks? Because oftentimes for investors, they end up buying right, but sitting tight or knowing when to exit is the problem creator.
Yeah, but once you have bought well, 90% job is done, in the sense that it will double, triple. I mean, I typically buy it for doubling in 3 years.
Right.
So that's my game.
Right.
And either it will double in 2 years or it doubles in 4 years or whatever. Either you are right. When you are right, you make it much earlier, because the companies and markets are not going to move at your pace of thinking. It happens very fast. So I have typically seen wherever I am successful in investing, typically it works out. What I think in 3 years will happen, it happens in less than 1 year only. Okay, so having seen the stock grow, say something you bought at 100, it has become 200 or 300 or 400. After that, then you are looking for when to sell. So when to sell you must never fall in love with the stock which you have, but you must also allow the entire growth trajectory to pass off, because if something is growing, it will keep growing for not 1 or 2 years or 2 years or 3 years, maybe 5 years, 7 years. So by sitting tight for 5, 10 years, you will be able to squeeze the benefit of entire growth over the cycle. Okay, but you can always sell it too early. A lot of people, they sell too early.
Absolutely.
They have a formula: if it doubles, we sell; if it triples, we sell. But I think whenever you see either MOAT is going or growth is going.
Okay, then it's time to.
And typically both of them go together. That is the point of time you should definitely either reduce the allocation or get out completely.
So I want to shift focus a little bit to the startup space, because that's one area where we're seeing a lot of interest in startups. What is your take on this space? Because while they're extremely highly valued, they are not yet making money. Now this goes against one of the fundamental principles that you usually talk about.
Good thing is that still startups are not in public market space. It's all in private. Venture capital and private equity, they are doing it. Okay, so they are professionals, they understand what they're doing, and they're very global in character. Most of these startup funds, they're all global funds. So my thinking is that I will not invest till I understand the business.
Okay.
Till I see the profits or potential of profit, I will not invest. So the current game of internet-based, because these are very unusual times again, because where the world is getting connected with 6-7 billion smartphones in few years. India itself will have 1 billion smartphones. So how the lot of commerce, consumer-centric commerce is going to change, particularly in services. So banking services, or how you buy mutual fund, how you'll do your broking, how you'll order a lot of groceries at home. So I think those things, paradigm will shift completely. So those businesses, they may not be doing today well, but they have a tremendous potential of making money in the future, and making money on a very large volume transaction. Because once you are successful in the internet, online, then scalability becomes one of the biggest thing about internet, is that scalability is literally unlimited. You can be $100 billion, you can be $200 billion. So, and you can be local, you can be global. So those potentials are there. So I'm not good at it, but there will be somebody, who will be able to do well.
So right now you don't see that vision of profitability really coming into the sector?
I've actually not applied my mind.
Okay.
Whatever little I see, you read in the papers, I really can't figure out, like Uber,
right,
at $60-65 billion of valuation. It's a wonderful service. I also use it. But to understand the valuation, I'm maybe old types, I'm a value investor, so I value the earnings, cash flow and those kind of things, which is not there. But eventually, maybe I'm not able to see it, but those who are valuing it at $65 billion, they can see it maybe after 5 years or 7 years.
Okay.
So it all, see, ultimately they have to earn what they're, if somebody is buying at $65 billion, the franchise must deliver $100-200 billion of profit in the years to come.
Is the IPO segment now looking exciting? We've seen some interesting listings in 2015. You've got VRL Logistics, SH Kelkar, Manpasand, some of them in very niche segments, and we've also got a strong pipeline for 2016.
I think this year has been particularly very good. Today only we saw Alchem listing with a kind of a good pop, and I think one of the most celebrated listing was Indigo, which is a market leader in the segment, and it's almost like 50-60% up with a huge kind of attention. So we are seeing quite a few high quality companies coming in. These are tough times, so very bad companies will not fly.
Right.
So I mean, it is very interesting that good quality companies are coming in, and I think it's a terrific time for investors to log in very quickly at the time of entry itself.
Last time we spoke, you had spoken about Adrian Slywotsky's works on value migration, and Hero Honda was one such bet in the 90s. Any similar emerging trends that you're seeing right now, possibly something like a small ticket housing finance?
See, this value migration keeps happening from one segment to other. So clearly we are seeing in aviation from a full service to low cost is happening, in the sense that all the companies with the business class and entitlement of miles and food and all those kind of things, those airlines, they are giving way to the frills free airlines. So big value migration is happening there. Then we are seeing that so that's one place which is very that is occupying my mind to some extent, but this will keep happening. Business after business, it will keep happening, and one can benefit out of this. It is one of the most powerful and most least exploited framework for making money in the stock market.
Time now for another quick break. We'll continue this conversation with Raamdeo Agrawal on the other side. Stay tuned. So another key takeaway from the report is that markets are a slave to earnings growth. I think 2015 is one prime example of that, because most of the volatility was because the earnings didn't pick up as we thought they would. When do you see that happening, or do you think it's going to take some more time? Do you think it's going to be 2016?
I don't know. It is surprising. The pace of decline. See, what is happening is the market has become a two-speed market, clearly. It's a complete reset for the global economy with the oil and all kinds of commodities, soft commodity, hard commodity, industrial commodity, oil, gas, coal, energy. Everything is just down by 30 to 50%, or maybe even now oil is down more than 60%, 65%, from 110 to now 35, struggling. So clearly, these are unprecedented kind of adjustment. So the producers of commodities, those corporations are in very bad shape, and they are almost knocking the doors of bankruptcy. So that has hurt the total aggregate corporate profits. But rest all of the users of commodities, so they are benefiting, but that pass through is very slow, and in between there is an inventory loss also.
Right.
So I think this year and maybe another, December definitely is going to be impacted by this. March also might go into this. But if you talk about 16-17 financial year, probably on the back end things could be much better.
Okay. For 2016, any specific sectors that you believe are poised to outperform?
See, the biggest theme I would say running across, whether it is consumer, whether it is automotive, whether it is a bank, whether it is a pharma, I think one of the things is the companies benefited by burst in the commodity cycle with a good pricing power. So a company like say Pidilite, or a company like say Britannia, these are companies which are in consumer segment, but the raw material costs have come down because say plastic packaging price have come down, soft commodities have come down, or sugar has come down. So their margin is going to be expanded, but they don't have to pass on. Bulk of it they keep it themselves, so that in future whenever inflation comes, they'll be able to sell it off against that. So these kind of companies, they will do very well, because right now we are in slow growth mode. I still don't see hyper growth for Indian economy, or even for that matter world economy. So clearly you will find a slow top line kind of situation in next 12 months at least, and good margin expansion spaces. So top line will go 15%, bottom line will go 40-50%, and the stock might be available at 25, 27, 30 PE. So you are not buying that cheap, but adjusted for growth, you are very well off. and that's how you might make 25-30% return in that particular stock. So I would think all the companies which are going to be, which have pricing power and are significant beneficiary of commodity collapse.
Right.
Those are the companies to buy. Second, that you have direct play. See, one of the things which is emerging, I mean, if power sector reforms really work out. Today I was reading in the paper that in next 3 years time, all the power companies, all the distribution companies will become profitable. Now, 3 years is 3 years. We don't know. But if it was to be taken on the face value, this could prove to be one of the biggest source of making money. Whether in electrical, distribution companies, they need a lot of equipment to be bought, T&D equipments. Then you have all the generation companies. They are literally bankrupt today. They will start making decent amount of money. So I think these kind of themes under the new government or under the new cycle of investment and reforms, and when you combine the beneficiaries of new government, then benefits of commodity collapse and reasonable price. When you put all three together, you'll get ideas.
So where do you stand on this whole mid-cap versus large-cap debate? I mean, I know you've said that you should have a mix of both, but given the value erosion that we've seen in the large caps and the outperformance of the mid-caps, any bias at all?
No, I don't have any bias.
No bias.
If I get quality and growth, I don't care what is the size.
Any final words of advice for investors who are planning their investments for the new year?
Yeah, so I would think that currently markets are at about 70% to GDP. Market cap to GDP is about 70%. So everybody, and we are under invested asset class. So, but the serious money is made here. 15 to 20% return compounded is made in equities over a period of time. So my sense is downside is limited. Upside nobody can tell. I'll be wrong if I say that market is going to go by 15%. Last year also I must have said 15%, because that's a permanent tag. 15%, 20% it will do in second half of the year. So that goes on. But my sense is on a 5-year basis, you have a very good chance, very high probability that the index itself will double and well-managed portfolios might triple. So downside is limited, upside is very attractive. You must invest. I mean, there's a good time to invest in a good quality portfolio. Don't bother too much about individual stocks.
Right. If
you don't know how to handle, because another thing is that competition for individual investor has become significant with the institutions coming in. So they are disadvantaged to some extent, unless they go to very small cap companies where it is below radar for institutions. So serious investors must take help of managers and deploy the manager or buy into managed portfolios. But most important thing is how much you have allocated to the portfolio.
So do you think FIIs will view the Indian growth story in the same way? Do you see those flows coming back?
It's a matter of time. Okay. There is no other way. Either we don't grow, or if we grow, they have to take notice of it. And first point of where they will enter from into global equities will be India.
All right. With that, thank you very much, sir, for joining me on the show.
Thank you.